EP&T Global, welcome back by the way, is a world leader in reducing energy consumption and carbon emissions for business operating in the built environment. So over the past 25 years, the company has pioneered and refined the technology to extract, analyze, and report data to reduce building energy use. So that is both saving the money I should say, and helping the environment in the process as well. It was founded in Australia back in 1993, and since then, EP&T has expanded into 18 countries in Asia, Europe, the Middle East, and North America. Presenting today is Trent Knox, who is CEO of EP&T Global, and also Richard Pullinger, who is the CFO of the company. And my friendly reminder, as per usual, if you would like to ask a question, you can just go to the Q&A button at the bottom of the screen. You can enter that question anytime during the presentation, and we will look to answer your questions toward the end of this session. So without further ado, Trent Knox, CEO, and Richard Pullinger, CFO of EP&T Global.
Thank you so much, Nadine, and thank you for the lovely warm welcome. Just before we even start on the presentation, a very big thank you to all that have joined today. And on behalf of Richard and I, we're very excited today to be talking to you about our business, EP&T Global. So I'll just kick straight in. We've got a short presentation to go through, and then we'll be excited to answer any questions that you may have. So as I'm sure a lot of you in this particular segment are aware, you know, we live, we work, and we play in buildings. And EP&T Global was born out of a need to manage buildings better. Buildings aren't alive, we know that, but they are dynamic. And they are required, we are constantly looking at ways to enhance the performance of a building to respond to human and business needs. We need to be in lockstep with the environmental conditions. And these conditions are constantly changing. And this is where we come in. EP&T has grown over the last circa 25 years to be one of the world's best building energy management technology companies. And as I said earlier, Richard and I are excited to be able to explain to you just how and why that is. So buildings use over a third of the world's energy and drinking water, and they emit over a quarter of its carbon dioxide. Every year, businesses lose hundreds of millions of dollars due to inefficiencies, old or faulty equipment, and in the end, just sheer wastage. These incredible statistics can be reduced, and we see that happening each and every day as we work with asset owners around the globe. So we have a big addressable market to talk to. The International Energy Agency estimates that the current global building stock is 223 billion square meters, and will almost double to 415 billion square meters by 2050. Smarter buildings can help in the fight against climate change. They can create jobs, improve energy security, and lower energy costs. What we've seen over the last, I guess now it's probably the last 6 months, we were at circa 280 assets globally, and we are now at 360 assets. And Nadine very kindly pointed out we're in 18 countries, and I'm very happy to say we're now in 22 countries, which Richard will expand on a little bit later in the presentation. But all that said, you cannot manage what you do not measure. So we at EP&T have been collecting and leveraging building data for the past 27 years. And people say, well, what does that actually mean? Well, you know, if you think of it as so trying to put it into perspective, if you had an EKG on your heart, there is data and monitoring to figure out what's going wrong and how things can be improved. Well, that's exactly what we do. We've got the Edge Intelligence System, and it's sort of like an EKG in your building. The amount of data that we've collected over the years enriches the artificial intelligence and gives us the smarts to be able to give asset owners every opportunity to improve comfort conditions, lower costs, and create better sustainability outcomes in their asset. So that's done through a number of ways, but we are constantly collecting data. We collect 5.6 billion points of data on an annualized basis, and we're putting that to work each and every day. We have an opportunity to work with asset owners tenants, operators. So we are across all factors and facets at an asset level. So how do we do it? It's pretty simple. It's the Edge Intelligence System, as I mentioned before, but what we are actually doing is we are capturing data. So we have the ability to access granular high fidelity data from multiple sources. So this could come from building management systems, it could come through sensors, weather data, tenancy data, our own sub-metering data. So we've got a number of ways we go out and collect that data. It then comes back to our system where we aggregate all of it, where it's cleansed and is formatted. From there, we analyze using our proprietary algorithms, which gives us the opportunity to get out there and solve. And this solving is really a collaborative piece with the asset, the folks that are at the asset level, so we can work with them to make sure we're giving them every opportunity to get the very best out of their asset. And to be very clear again, this doesn't just need to be around energy and gas or energy and water. We're constantly looking at ways to work with customers to understand their specific needs in their assets so we can ensure we're giving them the very best outcome. And this could be something as simple as really just managing water or monitoring water for leaks at a big industrial portfolio. And we can save hundreds of thousands of dollars in just doing the simplest things in assets. So, we are constantly driving performance across multiple verticals. So we work in commercial offices, we work in shopping centres, hospitals, hotels and leisure facilities, schools and universities, and industrial properties. We can work in a single site, or we work across a number of larger portfolios. And to give you some examples, we've been very fortunate to work with the likes of British Land, Stocklands of the world, Link REIT over in Hong Kong, Goodman, ESR. So we're very fortunate to be able to work with some of the real key blue chip clients globally. But at the same time, there are so many asset owners out there that might have one or two assets, commercial buildings, offices, that don't have sustainability teams. They don't have the insights or the people or the wherewithal to be able to go and find insights. And that's where we are coming into our own. We're finding more and more of the big consultancies reaching out to us saying, we understand what needs to happen, but we just don't have the data to drive performance, and can you help? And the answer is simply yes. And there's so much more than just simply saying turn off an air conditioning or turn off the lights when you leave. These assets, 50, 60, 70-story buildings have got are constantly burning energy at some source or another, and they're all being driven by controls, generally a building management system. And if these controls get out of whack, then no single person could potentially ever really understand what's happening. And that's where we can sit in the background and really work as a bit of an insurance policy to make sure that those controls are managed, and that the people within the assets that are controlling those, are managing those controls, again, are given opportunity to fix them. Technology and human expertise intersect, as I say, and we're there to collaborate with those owners and operators.
EP&T we're global, and the global macro environment at the moment strongly supports our capability. There are high electricity costs, there are global targets to reduce carbon emissions, such as the Paris Accord, neighbours and GRES here in Australia, but also across the world. And we, EP&T, are very well positioned to take advantage of this. We've got an established global client base already, and coupled with a proven global solution. As Trent mentioned, we're currently in 22 countries across 4 continents, and we service these customers out of our 4 global offices, out of Sydney, London, Dubai, and Hong Kong. Our domestic and also international client base is blue chip. We work with the highest quality of customers, and we're currently installed in over 350 buildings across the globe. Our long-term relationships with our clients, they're also key. So across the entire portfolio, we have an average of having worked with our clients for 5.3 years, and across our top 10 clients, this increases to 9.3 years.
So this is a fantastic slide, in as much as it's a lovely representation of how we can work with the big operators, the top end of town, to help in their assets. So This particular case study, as you see in the bottom left of the slide, came from the Derwent London responsibility report they put out in 2019. And what they were saying on our behalf, which was just, doesn't get much better than this, they were saying that based on the relationship and the continuous monitoring across the large multi-let buildings, we have been able to, since we've installed, we've saved Derwent 20,701,000 kilowatts against their baseline. So against their actual given bill, that energy bill, that's how much has been saved in the period. And the total performance in 2019 alone, saving over 4.5 million kilowatts against baseline. So again, what makes this so exciting for us is this is not just EP&T spruiking our wares. This is a big, big property group saying, without these guys, we wouldn't have had these results. With these guys, we've had the results. So a big tick, and again, very thankful to have businesses like this working with us.
Since March of this year, EP&T's really built up some great momentum with some big contract wins across the globe. Some great examples of this was the recent award of 42 buildings across 11 countries in Europe with DWS, an affiliate of Deutsche Bank. We've also picked up some new contracts in the education vertical for the first time, both here in Australia and also in Dubai. And on top of this, a further 16 properties have been picked up or won in Dubai in the last 3 months or so. Combination of these and some other wins has increased our ACV, which is our annualized contract value, by 34% since March. Interestingly, when we've sort of circled back with the customers that we've won these projects with and asked, why EP&T, why choose us? The key recurring themes in the commentary has been, you've got a global footprint and you can deliver in multiple territories across multiple verticals. Great case studies, great caliber of existing client base, gives customers a lot of comfort. And also our client engagement, our people, the way they interact with these potential customers is really getting us across the line. So all across the board, a real great improvement for the company. So annualized contract value is one of our key growth metrics. Just as a bit of background to this, our contracts with our customers typically take the following form. We charge recurring flat monthly fees, and these can range from typically from $10,000 a year up to $60,000+ per year per site. It just depends on the size of the building, the complexity, and the scale of the system and service that we're going to provide. We enter into long-term contracts, typically between 3 and 7 years. There's no upfront payment required by the customer, so no big capex requirement, and EP&T retains ownership of the installed equipment. So ACV is the annualized amount that we would charge under a contract on hand. So based on the examples I just mentioned, if it's a $10,000 a year contract, then the ACV for that contract is $10,000. So as you'll see on this graph here, we've had significant consistent growth in our ACV over the past 3 years, and over the course of the June 2021 financial year, an increase 43%. Slide here is just showing a summary of our key operating metrics. All of our trends that we measure the business by are moving in the right direction. ACV, as we've touched on, 43% growth in the current year. We have $36.6 million of contracted fees remaining on contracts that we have on hand today. So those are contracts that we have that we've not yet billed over the remaining course of their life, $36 million. An estimated lifetime value of these contracts of over $108 million. The average term remaining on these contracts is increasing to 3.4 years. So as we enter into new contracts and longer term contracts, we're locking those customers in. And under our recurring revenue model, the proportion of our total revenue made up of the recurring base is increased to 82%, up from 45% in 2019. Just by way of reference, in terms of our market cap, we're currently sitting at around $34 million, which is actually a 3.1 times multiple of our ACV. That really, when you look at that compared to some of our peers in the market, really does represent very good value. Our entire portfolio.
Sorry, Richard, I can take this if you'd like.
Yep.
So we've got, across our total portfolio, we've got 22% of annual energy savings. So that's across our total portfolio, an average of 22%. In the last five financial years, we've saved over $110 million for our clients, and over 100,000 of tons of CO2 are removed annually. These are strong, they're strong numbers, but particularly when you look at that 100,000 tons of CO2 being removed annually, it is significant. Just to kind of touch on the sustainability piece a little bit more when it comes to green credentials for the buildings. What we are hearing more and more customers come to us and talk to us about opportunities to improve sustainability ratings within their portfolios. Now, that may come in Australia in the form of NABERS, which is probably one of our strongest sustainability agencies, particularly in the commercial space. GRESB is an international rating, as is the Dow Jones Sustainability Index. What is interesting is in NABERS is now getting into all sorts of different verticals. So they're coming into schools. So NABERS are calling it NABERS Accelerate. So they'll go into schools, they're going into data centers, cold storage. So these are all asset classes that sooner or later are going to be judged around having these certain sustainability ratings, and if they're not already. And what we're seeing, and this again is come from a source that we've derived, where basically they're saying that if you have the right green credentials in your asset or in your portfolio, you have a greater opportunity to see stronger rental income, higher occupancy, and clearly a greater asset sale price when it comes to that point in the life cycle of that asset. We also know that even here in Australia, if you're in a government agency building or some building that the government are looking to tenant, they won't come into the building unless it's got 4.5 stars. This again is just a nice representation of some of the big end of town that we've worked with over the years in helping them derive some wonderful awards and prestigious awards at that for what they have done in their attempts to become have a strong sustainability focus. So again, a fantastic plus just to see all these different operators getting involved.
Just touching back on our customer engagement model again. We've listened to what our customers are asking and how they want to engage with us. So we've transitioned to a model whereby we're charging a very simple structure. It's a flat recurring monthly fee. It's an operating cost for our customers. So we're really aligning ourselves and the costs of our system to our customers with their savings. So they'll be saving monthly amounts from their energy consumption going down, and we're charging monthly amounts to them. So it really delivers an immediate ROI. The key driver for this, for EP&T, is that it enables us to shorten our sales cycle, as well as go in with a very tailored, very specific solution for our customers, which may just be for water or gas rather than the entire energy suite initially. So we go in, we prove ourselves, and then we're able to penetrate further into our customers' portfolios and deliver them more and more value.
So just to offer a couple of company highlights just before we finish up here and answer any questions that might have come from today's presentation. As we've pointed out, we have a globally proven technology. We are able to operate across a number of verticals with success, and that again has shown through our ability to grow and for the fact that we're able to continue to deliver the savings that we deliver to our asset owners. We've got a global client base. I mean, as Richard mentioned earlier, to be able to be fortunate enough to say that we've picked up a wonderful new win with Deutsche Bank for across a number of countries for some of their key assets is very, very exciting for us. We've got a large addressable market. We talked before about just the size of the when you look at globally at the buildings that are sitting in the big cities and how many different asset classes we can work in. So to say that we don't have, the market is shrinking is certainly not the case. And also, it's lovely to see that our operating metrics, are paying off, based on some of the super initiatives that we've been able to put into play. With the fully transition to the OPEX model, we are looking for, we're spending, as we had said through the listing, that we would allocate a lot of our funds to sales and marketing, which we are doing. We're trying to make sure that we have the very best technology available, which we believe we have now, and we can just continue to refine. We've got some fantastic people in the business, both here in Australia and the other countries we operate. So we feel we are really in a great position for growth.
Quick overview of our capital structure. So we have approximately 186 million shares on issue. Keith Ginneratney, who founded the company back in 1993, retains 31% ownership. Board and non-executive directors, 2.4%. We have some great institutional support through the likes of Perennial at 14.6%. So overall, institutions make up approximately 45% of our shareholder base. And following the listing, approximately 61% of the shares currently on issued are escrowed. The first portion of those come out when we release our results at the end of August.
So to finish, this quote has come from somebody particularly famous, but we certainly like to utilize it in as much as we do believe, and this is where our sense is, as we move forward, we can do a lot of work to help in energy savings and in turn, better the environment. But the greenest and most cost-effective energy is the energy you just don't use. So, we see as we go through and we continue to work with different clients, whether it be, as I say, in electricity or gas or water, whether or not, there's a view on climate change, etc. Everybody has one, but what we see is waste is just waste, and there's no need to do it. So any way we can get involved to eradicate that waste, we believe that's the place that we want to operate in. And we do it at an asset level whereby it's not just around, this greenwash. It is a sense of people really taking responsibility for their assets and wanting to do the very, very best for their tenants, but also for the environment. So again, a big thank you to everybody that's joined this call. I'm sorry if it's been a little clunky going back and forth. Richard and I are in different places, but hopefully we got across the message nicely for you. And I'll hand it back to you, Nadine, for any questions that people may have.
Thank you. No, we're all very used to having people in different places, I think, at this stage of the game. So all good. We've got a question coming in from a participant saying, thanks for taking my question. Looking at the prospectus, 2 questions. Number 1, the ACV and UCV for Australia has been declining since June of 2017. Is there a specific cause for that? Why don't you answer that one, and then I'll get to the second follow-up question.
Go ahead, Richard.
I think that the simplest answer to that is, the focus of the business shifted to international growth for a while. It was a founder-led business. The sales were very much founder-driven for a long period of time, and the founder was off building the business in the UK, UAE, and also Hong Kong. So, having established a very strong base here in Australia, I guess for a couple of years back there, the eye was sort of taken off the ball here in Australia, but Trent and I and the entire team see that there is a huge market still here in Australia, and we're investing time and resource in rebuilding that, and we're really starting to see some a complete turnaround. We've actually added over the past 12 months or so, we've added, I think, approximately 40 or over 40 sites back into the Australian business. Those were sites that we didn't have before. So it's there, it's a great market, and we're really starting to address that and see the benefits as that's turning around.
And the second question there is, why is there a bigger gap between gross and net ACV since FY19? Does that represent a churn of sites?
The difference between the gross and the net is really it's a timing issue around when we sign up a customer and when we're actually seeing the revenue and the cash coming in from that customer. So there've been some obviously challenges over the past 12 months or so with COVID and getting into buildings and doing, and some challenges to some of our customers. So that figure did grow for a couple of years, and we're very focused on bringing that back down and implementing KPIs and other measures to make sure that we close and essentially eliminate that gap.
Another question, which sales channel does the company expect most ACV growth from in the medium term, from direct sales or channel partners? Maybe some color on how the DWS contract will come about would be helpful as well.
Sure, I can take a run at that. So I think, and sort of this is going off the back, Nadine, a little bit of the question that came in earlier around the Australian market. We had the business has always had a very direct channel, direct sales channel market, and that had always been very much founder-led. What we've seen now is, we've started bringing some more sales resources into the different markets, and so that certainly does help and escalate growth. It's great, but there is always a time lag from when getting into these assets. That said, we're finding more and more opportunity because our marketing is improving, so we're getting more inbound inquiry. We've got lots of great customer reference points, which have been very, very helpful. We're talking to a lot of sustainability agencies, consultancies that are looking to get involved. So I think it's going to be a real mix of making sure that we're cross-pollinating as much as we possibly can to re-educate the market on the EP&T, who we are, what we do, why we exist. And I think that's probably what was lost in Australia for a minute or two. DWS was a very interesting one. That was, we were invited to a tender. We went up against, I think, circa 8 other, very good energy management systems. And we went through the tender process, a formal tender process, and we won. And we won it on the fact that they were very clear. They loved our technology. They saw what we could bring to the business. They thought that our people were particularly professional. They could answer the questions that were being asked. And they said, quote unquote, we listened. So, it's again, each customer seems to have different needs at the moment, and it's very important for us to make sure that we're looking at different solutions for those different customers to make sure that we're scalable, but at the same time that we're giving them what they need.
Another question, can you talk to how you differentiate yourself from the rest of the market? I think you've answered that in part. This sounds like there's a number of players, but you're winning global accounts, which are impressive. So what is the secret sauce?
Look, I think, I'd be the very first to say, there are lots of different opportunities for asset owners to improve or try and get to a net zero, which is very much the conversation at the moment. One of in talking to, a number of our bigger clients that have been around and have sort of looked at competition, there are a number of different providers that say they do what we do, and that's fine. And most of them, I'm sure everybody has different good solutions, but when they really want to get into and understand their asset at a very granular level, you can't beat 25 years of data collection and just the plethora of information we have in the background that can help asset owners to make good decisions. We've got super clever people on the ground that can assist and collaborate. So I don't think there's a single item why we are better or we do something, in a different way. I think that we can be a more all-encompassing solution to many other solutions that are out there in the market. But I also think, as new entrants come in, they're going to understand that they've got to then build up their book of data or their data lake, so to speak, which we have. So I just think that will be something that if we use it effectively on a go-forward basis will be very important to us and to the customers we represent.
I think there are very few others in the market, Trent, that have our longevity, that can demonstrate the proven track record that we can. I mean, that's key. We can point to real results for many years for many customers, and there's not many in the market that can do that.
So when you talk about the macro environment, obviously favorable right now in terms of the push towards energy efficiency and the like, but has there been a noticeable impact through this economic slowdown and snapback in terms of the amount of investment that some of your blue chip clients are willing to put into this effort?
Go ahead, Richard.
Look, I think, it can vary market to market. I think what's been really noticeable over the past 6 months or so is the UK and European market. They've come out, obviously a COVID impacted economy with a huge focus on ESG and sustainability and, rebuilding their economies in the right way. So a big focus on sustainability, on all sorts of green credentials. We're seeing that in Australia as well to a much larger extent now than we have done in the past. So I think it is a real focus, but I think the real beauty of what we do is that we save money. There is very much a sustainability angle to this, but even if that was not there, there's a commercial aspect to this whereby we can demonstrate positive financial returns to our customers from what we do. So we tick both boxes. We tick the box for the finance guys in terms of saving money and generating positive returns, but we're also ticking the box for the the sustainability teams and the boards who have to start looking and reporting on ESG. So we're very fortunate with the way that the world is focused on ESG, but even beyond that, we have a very clear benefit to our customers.
Got it. Well, listen, we are out of time, if you believe that. Trent Knox, CEO, and Richard Pullinger, CFO of EP&T Global. Thank you so much. And thanks to our audience for the questions as well. We'll be back shortly.
Thank you so much, Nadine. Thanks to all.